All right, topic A tonight. Stocks had a terrific quarter. The Dow's best quarter in 12 years, rising 6.4%, while the small cap Russell rose 7.6%. This is great. But oil and gold are surging higher, and that is not a good sign. Oil prices hit a 2.5-year high today, closing in on $107. Gasoline prices have doubled in the past 2 years, closing at $3.60 nationwide at retail. All right, elsewhere, jobless claims fell. That's good. Tomorrow, of course, we're going to get the non-farm payroll report. However, core capital goods orders fell for the second straight month in February. Meanwhile, a solid Chicago Fed manufacturing report also saw 83% of companies reporting higher prices. And one Fed president is thinking out loud about a 50 basis point hike in the central bank's target rate by year end. So let us ingest and digest with our expert market panel. Here now is Brett Ahrens, columnist at the Wall Street Journal, Lee Munson, chief investment officer at Portfolio, and Jordan Kimmel, market strategist at T3Live.com. Brett Ahrens, walk me through this. A great quarter for stocks, no two ways about it, beating all the internet, Japanese disaster, Libya, Egypt, and the Middle East, and so forth and so on. And yet, Brett, disquieting signs in oil, energy, gasoline, and gold. How do you see this tug of war playing out?
Well, be careful what you wish for. A headline I looked at just as I was coming out to come to this program said, stocks have best quarter since 1999. And I don't know whether the headline writer was, it's like, ship has the best launch since the Titanic. It doesn't really, fill you with a lot of confidence. Listen, we have QE2. We have a lot of money printing that has been fueling a lot of this. We're seeing this in gold. We're seeing this in oil. We're seeing this all sorts of stuff. It's been great for stocks. On the trade, the trade has been fantastic. What it means for investors is a little different. We're seeing the inflation coming through in all sorts of numbers now. And, if the Fed, as it were, takes away the punch bowl, you can work out what happens from there.
That's an interesting point, Lee Munson. Mr. Lakota, if I pronounced it right, I believe he's the president of the Minneapolis Fed, thinking out loud today about a 50 basis point hike in the Fed funds target rate by year end. And some traders are saying that Bernanke's news conference on April 27th after the FOMC, our own John Malloy is writing about this, could be a disaster for stocks because Bernanke may be forced to admit that QE2 comes to an end and tighter money is on the way. What is driving this market? Is it easy money from the Fed? Is it corporate profits? How do you reconcile this?
I don't think there's anything driving it. Last quarter, I want to make money for my clients. We knew that there was easy money. We had great economic numbers. You and I have been talking about all quarter about the great numbers. Everything was great. But hey, listen, right now, we had a great quarter. Why do we want to push it? I don't have an interest in stock. I think let's do some spring cleaning. Okay, back there, I'm out in Scottsdale right now opening up a new office because there's a demand for pragmatic leadership and not dogma. There's guys coming in here who are long-only mutual fund managers on their Gulf streams who, as we saw at the end of this quarter, bid up the prices of things like AT&T that are high dividend rate payers because they know the market's not going to go anywhere for the next quarter. I say you look at commodities, you look at trying to buy things like copper cheap. I think you just take a break. You just got to work at making money. I got to make money all the time, so I want to make some money in currencies. I think it's right time right now to start looking at a short treasury positions. I think it's the right time to look at trading things like copper. But I think if you want to clean out and do some spring cleaning, take a break on stock. Everybody made 6%. I don't see why everybody's so excited.
Jordan Kimmel, hang on for 1 second. Okay. We're going to lead with you. We're going to take a little break here. There is some inflation in the air. It could affect a lot of companies. It could affect consumers. It could affect profits. Let me turn to CNBC's own Brian Shackman with some of the details. Good evening, Brian.
Hello, Larry. Everything's up. That's all you have to say. All you have to do is look at the CRB index. Raw industrials now from cotton to tin up 24%. Copper, as your previous guest talked about buying on the cheap, well, it's up 20%. And of course, as you might imagine, foods up more than 40%. People made such a big deal about Hershey raising prices today, but to Larry's point, it's not just about food. Take a look at sugar versus oil year to date. Okay, I want you if we can just get that up quickly, because it'll show you that sugar is down and oil is up. We're talking crude up 16+%, sugar down 15%, so it's packaging and fuel perhaps more than anything. That's not to say raw materials aren't a major concern here. Aaron Smith of Superfund said today that coffee, sugar, and cocoa could go up 5 to 10 times between now and 2014. It's a pretty shocking call. But I want to warn people, you have to go beyond the headline here. Commodities make up about 40% of this $1.25 billion in assets here. They're also talking their book. Then there's Walmart, the country's largest retailer. U.S. CEO Bill Simon said inflation was, quote, serious, nothing we didn't know. And again, dairy, cotton are major problems, but he's just as concerned about transportation-related costs. Now, you get the point. It's not just about food, folks. Now, if Walmart raises prices the way they've been performing, 1 year down 6.5%, not taking part in the rally, you know it's something they absolutely have to do. So the question I'm going to ask is, where do you make money here? The USDA said today they expect farmers to plant the second most acreage since 1944. That means, of course, you have potash, CF Industries, Agrium. We're talking about the fertilizers and even the secondary play like Deere making the heavy equipment. Those are the places where money went in today. All huge gains. You saw 3+ for CF and Deere, 2.5% to the upside. Larry, here's the key. Everyone's been jawboning about inflation's on the way. I don't know what the Fed funds rate and all that says, but what this tells you is that it's already here.
Already here. Terrific, Brian. Thank you very, very much. We come back to our distinguished panel, Brett Ahrens, Jordan Kimmel, and Lee Munson. Jordan, I owe you. You were very patient during that break. Inflation is in the air. Oil's headed towards 110. Gasoline is headed towards $4 a gallon at the retail pump. Now, question. Is inflation something to just ride up? Is that the way to play this, or is this going to come to no good?
I'm not sure even that's the question, Larry. I think we all talked about a lot of scary things right here, and who knows it? We know it. The market knows it. We didn't break any news that the Fed's going to raise rates. The market knows that already. What's the most bullish thing the market could do is go up. So we know how markets end. Bull markets end when averages go up, but stocks start to go down. The advanced decline line starts to taper off. There's a few leaders left. The advanced decline line hit a high in this whole recovery cycle when? Today. So when you're talking about inflation...
But what is does not mean it will continue.
No.
That's, I guess,
right.
Look, I'm a better bull than a bear. I love to be an optimist. But I am worried, for example, from Brian Shackman's report, these commodity prices could eat into corporate profits, and we're going to see those results in the next few weeks. Are you at all concerned that profits will let the stock market down?
Well, you have to always be concerned about everything, Larry, actually. But when you come down to it, what we're talking about is own those stocks, own the energies, own the commodity stocks, own the industrial stocks, own the Caterpillars, own the Deeres, own these companies.
Right.
This is how to make money.
Right.
Now, remember one thing, too. 5% of the world lives in the United States. There's a global build-out going on that is unstoppable. The consumer demand, the industrial demand, farms turning into industrial farms, it won't stop.
Brett Ahrens, you heard what Jordan Kimmel said. What is your reaction to that? You're on the pessimistic side. How do you react to what Jordan is saying?
Well, I guess I don't want to be too pessimistic. What I do want to say is I think that stocks have priced in a lot of good news, and they haven't priced in a lot of bad news. In terms of commodities, one of the guys I talk to regularly is in his 70s. He's been doing this investing very successfully for 4 decades, and he likes to point out that, agriculture is the commodity that is most responsive to prices. Is that when prices go up, people plant more acreage. Now, obviously, there's only a finite amount of acreage, but, we've been living with the Malthusian theory that we're going to run out of land for several hundred years, and it hasn't happened yet. So, prices up, farmers plant more acreage, prices come down. Obviously, there's inflation come through. I think we're probably going to have the results for this quarter are going to be pretty good. The concern is more what happens, Q2, Q3, if these price pressures carry on through. That's when, you're going to see, I think, corporate profits getting squeezed. And as I said, stocks have already priced in a lot of good news. Unfortunately, the commodity play stocks aren't cheap. It's not as if, this is the, an open door waiting to go through. Everyone's already cramming through this door.
Lee Munson, on that point, commodities rode the wave, materials rode the wave, energy in particular rode the wave. Caterpillar for industrial is the best performer in the first quarter, and it was a terrific quarter. Then you have Chevron. Then you have ExxonMobil. Lee, is it more of the same? Is that the best advice you give to investors? Just ride this, or do we calculate a more cautious strategy?
I don't like, cautiously optimistic, cautiously bearish. Either you're in or you're out. I think that if you have those energy stocks, those commodity stocks, that's what I'm talking about. Just because I might want to trade copper, that's not much different than say trading oil. Now there might be some traders who want to argue with me and all this stuff, but if you're a Main Street investor out there listening to this show right now, and you have a lot of energy stocks, you have some ag stocks, you have things of this nature, I don't see why you need to do anything. I just don't see why you need to just leave them alone.
Well, wait,
I think if you want to make some money,
you're saying
you need to
ride it
clean
out.
out.
You're saying ride it out. No cash. You're not really turning much over. Just ride it out. I mean, I'm just asking.
I think you ride it out. But if you don't have those things, and you've got things like AT&T that's hitting highs for the year, that's a thing that you should think about doing some spring cleaning. You need to think about not things that like I'll sit around and collect a dividend. You want to stick with things that have a nice trend. And if it doesn't have a nice trend, blow it out. We've blown a lot of stuff out.
Friend. Jordan,
it's always your friend.
The last 30 seconds, I want to ask you about this. The Chicago manufacturing report today was very good, but the most bullish thing in the report was 83% of the companies reported higher prices. 83%. Second, factory orders, the heart of the CapEx movement up, down 2 months in a row, January, February. Now, does that concern you? Does that play a role, these kinds of numbers?
Again, I think the macro picture is something you have to put on the side of, if you will. As long as the advanced decline line's hitting a new high.
How can you put these economic stats and these inflation stats on the sideline?
I'll tell you how. By looking at individual stocks and individual revenue growth, margin acceleration. I call them magnet stocks. You have to distinguish
what's your favorite play?
The distinguished play, I think right now, is probably energy stocks.
Drilling stocks. All right, so that's just going to ride the wave? Because
that's the wave of the macroeconomic. That's the whole thing. You can't say it's because it's their margins or that. Energy stocks are moving because it's a proxy for the rise in energy. The global macroeconomic has to be taken into account.
And are we going to $125 a barrel, Lee Munson? Is that where we're going?
I hope not, but I think it's conceivable if it is. I think the only thing you should be holding are energy-related stocks.
All right, I got to get out, gentlemen. Thank you very much. Pretty quick rundown. Brett Aarons, Lee Munson, and Jordan Kimmel, thanks ever so much.